Thanks so much for the invitation to be here. I'm super excited to share this work. So I'm super excited to present measuring and mitigating racial disparities in tax audits. And this is joint work with Evelyn Smith, Tom Hertz, Cam Gwaje, Arun Ramesh, Robin Fisher, Dan Ho, and Jacob Golden. And let me just start with the disclaimer. The work presented here is the views of the authors and doesn't necessarily represent the official views of the Treasury or the IRS. So there's been a lot of work about how facially neutral features of the tax code can result in inequality by scholars like Dorothy Brown and others. But the motivating policy question of this work is there racial disparity in tax audits themselves? And so if so, what factors might be contributing to those? And then obviously, how might we mitigate that? The key challenge in doing this is that the IRS, and thus us, do not have access to self-reported race. So we can't simply compute an average of what the tax rate is by group. So I'm going to tell you about the sort of methodology and how we overcome this challenge. But before we do that, I just want to give you a quick preview of the results so we know where we're going. So the first result is that Black taxpayers are 3 to 5 times as likely to be audited as non-Black taxpayers. And this disparity is actually concentrated within claimants of the Earned Income Tax Credit. So for those of you familiar or not familiar with the EITC, it's a refundable credit, so you can actually have money returned to you if your total liability is negative, and it tends to be audited at a higher rate. Also, other work shows that there's differential uptake of the EITC by group. So a next anti-thought you might have is that maybe this disparity is coming from differences in EITC uptake and the higher rate of EITC. And we actually show that that's not the case, that there is significant disparity within the EITC claimants. Second, you might think that it might have to do with taxpayer features like income or filing status or dependence. And we show actually that doesn't seem to explain the disparity either, and neither does differences in underlying noncompliance. So finally, we look at what does seem to explain it, and it seems to be policy choices and operational design decisions, and in particular, a prioritization of refundable credits that drives these disparities. So by the way, feel free to ask any clarifying questions in the chat, and I'll try to address them. And if I miss it, just feel free to interrupt. So let's start with methodology, right? So again, the key challenge is how do we overcome this lack of self-reported race to actually get these estimates? We're going to leverage Bayesian imputation to get a probabilistic proxy for estimated race. And this is going to combine statistical information in first name, last name, geography, and so on to get predicted race probabilities that a taxpayer is Black. And then using this, we can construct provable upper and lower bounds on the disparity that will hold under certain conditions. And we will test that the method's underlying assumptions hold in the setting using a matched data set that does have self-reported race. And in particular, this is the North Carolina voter data set. So I don't want to spend too much time in the weeds or anything, but just to sort of convince you that it's not magic, right? That there's actually results behind it. I want to just go through the sort of results that we prove and rely on. First, taxpayers will have an audit status Y, which could be 0 for not audited, 1 for audited. They have a first name, a surname, and a geographic location, FS and G. And then they have an unobserved ground truth would-be self-reported race, either Black B is 1 or non-Black B is 0. And we're defining disparity as just the difference in audit rate for Black taxpayers versus non-Black taxpayers. That's the quantity that we would like to estimate. So as I mentioned, we need a imputation of sort of probabilistic predicted race. And we get that using BIFSG, which if you've heard of BISG, Bayesian Improved Surname Geocoding, it's just that, but adding first name as well. And it makes sort of a naive assumption that first name and last name and location are conditionally independent given race, which is obviously not true, but it works well enough in practice. And once you have it, you can basically get these estimates from the marginals, and all the things on the right-hand side of that equation are coming from data sets that are public, which I'll mention momentarily. And then in terms of these two estimators, right, I said we can get a lower bound and an upper bound. One is coming from a linear estimator, which is simply linear regression, regressing the audit outcome on this predicted probability Black and an intercept, and taking the OLS coefficient as your estimate of disparity. The other is the probabilistic estimator. That's basically just saying, I'm going to compute a weighted average over the full population, one weighted average using the predicted probability black as the weights, and one weighted average as the predicted probability non-black. And then I treat these as estimates of the black and non-black audit rates, and I can just take the difference. So those are two estimators. It turns out that those two estimators are not unbiased estimators of the disparity, but that's okay because we can actually characterize what the that sort of bias, statistical bias is. And it turns out that the probabilistic estimator, if you let the sample size get large, right, it'll converge to the true disparity minus a term. And the linear estimator will converge to the true disparity plus a term. And if those terms are both positive, then you're in business, and the truth is going to be sort of sandwiched in between the probabilistic and the linear limit. And again, you know, we don't need to spend too much time here, but just want to make sure that, you know, it's sort of clear exactly what we're doing, and I'll show how to test this and so on. And again, any questions, do feel free to interrupt. So now I'm going to move on to the empirical analysis. So I'll tell you first about the data that we have. So for you know, the sort of main part of the analysis, we use the tax return data. We have access to everything that the IRS observes. So 148 million tax returns in 2014. 2014 was the year that was fully available by the time, you know, when we started the paper, because it takes some time for audits to finish. Of these 148 million, about 740,000 were selected for audit, and we observe everything about the returns, including you know, the outcomes. Second, we have aggregated race data that comes from the census, the Home Mortgage Disclosure Act, and the American Community Survey, right? And these include breakdowns of surnames by race, first name by race, geography by race, and so on. And then we have that matched North Carolina voter file, which I mentioned, which does include self-reported race for a subset of taxpayers. And that was matched for us on an isolated server and then anonymized. And that's what we'll use to actually test that the assumptions that we need for our method to work hold. And then finally, there's the National Research Program, which is an IRS program that is a stratified random sample of taxpayer returns that they actually audit line by line. And so the key point here is that because it's random, it's free of the selection bias, so you can actually use it to think about counterfactuals. And now, I wanted to show how you would assess the methods of this condition before we get to the actual results that we find. And so what I've done here is I've taken the North Carolina data, where we do have this ground truth self-reported race, and I've split taxpayers into black and non-black, and then I've put on the x-axis bins of their predicted probability black, and on the y-axis the audit rate. Okay, so what this is basically showing is that, you know, for both groups, you're seeing this sort of upward trend in audit rate by predicted probability black. And so now again, the sort of key thing that I want to establish is that the conditions for our method to hold seem to hold in our setting. And so, like I said, right, in this theorem, we've got these two terms. Let's give them a little bit of interpretation, right? So this first term is the expected covariance of the outcome, audits in this case, and true race or self-reported race given predicted probability black, right? And so how do we see, like, is this term positive, right? Well, if you just think about what this is, it's saying fix a predicted probability black or a bin, right? Is there a systematic relationship, a systematic association between the audit rate and moving from non-black to black, right? And so you see that at every predicted probability black, there is that systematic positive relationship. So it's true on average as well. So we can think of this term as positive. And then this term is something about the expected covariance of the outcome and the predicted probability black conditional on true race, right? And so here we can look at both groups individually, right, and say, okay, there is this upward sloping trend for both groups. There's a positive association between audit rate and this predicted probability black, even conditional on ground truth self-reported race. And so, you know, this is also going to be a positive term. And since these terms are positive, we can treat the probabilistic estimator and the linear estimator as upper and lower bounds on true disparity. And so now that we've gotten that out of the way, let's actually talk about the results and what we see and what factors might be contributing. Okay, so we're going to just start with the overall estimated disparity from the probabilistic and the linear estimator. And we actually can get not just the disparity itself, but recover the rates, right? So this is just a simple bar chart showing our estimated audit rate for Black taxpayers and for non-Black taxpayers. So the dark purple is Black and the light purple is non-Black, and the solid bars are the probabilistic estimator, and the hatched bars are the linear estimators. And so if you look at these two rates, right, 1.2 to 0.4, that's a roughly 3 times relative audit rate difference. And so that's where the sort of headline finding that Black taxpayers are, between 3, that's where the 3 comes from, and then the 5 comes from the 1.7 to the 0.36, between 3 to 5 times as likely to be audited as non-Black taxpayers. So this is a pretty significant disparity, and note that we have so much data because the population is huge that this is precisely estimated. The error bars are tiny, you can kind of barely see them. So now I want to just talk about, now that we have that sort of headline result, what factors might explain disparity. And by explain disparity here, I mean, you could posit that, well, perhaps there are differences by group in various features like EITC uptake rate, like income or other filing features, but that within any of these features, there's no disparity, right? That is a possibility about how disparity could be generated. And we'll actually look at this as this possibility. So we'll look at income, EITC claim rates, some filing features, and we'll also look at underlying noncompliance. And so let's start with income, right? So what I'm going to show is, binning taxpayers by reported income, and then separately estimating the Black and non-Black audit rate. Again, if this were, explaining disparity in the sense that I mentioned, you would expect that within every bin, the audit rate would be the same. But that's not what we see. So again, dark purple is Black, light purple is non-Black, and reported income is on the x-axis. Audit rate for each bin is on the y-axis. And you can see there's sort of everywhere there's a gap, but it is particularly large in the sort of lower income, 20K, 30K, range. And that's actually around the range where EITC comes into play. So let's actually look at EITC status. And does that make the disparity go away, right? In the sense that, like, within earned income tax credit claimants, is audit rate the same for Black and non-Black taxpayers? And again, we see, no, it doesn't go away. In fact, at least in absolute terms, it becomes starker. In relative terms, it's similar. Again, it's about a 3 times rate, right? So Black taxpayers in the EITC are audited at 3 percentage points according to the probabilistic estimator. Non-Black are audited at 1 percentage point. In non-EITC, there is still a disparity, but it is significantly small. What about by return features? We'll look at single versus joint EITC filers, single male versus single female, single male EITC filers with dependents versus single male EITC filers without dependents. Each of these, drilling down with further features, the disparity doesn't go away. Roughly speaking, it's about the same on a relative basis, and in absolute terms, it's increasing, but maybe the relative basis is more informative. But anyway, it does not go away. So it doesn't seem to be explained by these features. But ultimately, what you might care about most is underreported liability. Are we auditing taxpayers the same once you look at their underreported tax liability? So this is a little bit trickier to construct because you can't just back it out of the audit data, the operational audit data, right? Because that's you only have the true non-compliance of the people that you actually audited. But that's where, again, that NRP program comes into play. And basically, we can use that to sort of get an estimate of the distribution of non-compliance by group. And then we can look at the conditional distribution of non-compliance using the operational data. And then we can back out what that implies, using Bayes' rule about the audit rate. And so here in this plot, I've taken, the $0 non-compliance out, and then I've made 10 bins of non-compliance, and then we estimate the audit rate for each bin and for each group. And this is just using the probabilistic estimator. So, that there is a difference in distribution across bins by group, but within every bin, there's a higher audit rate for Black taxpayers, and in some cases, it's, again, absolute levels. It's can be increasing, but it's roughly, I think, on a relative basis, it's similar to the overall estimate. So I see there's a question in the chat. If it's not a clarifying question, okay, question for discussion. Cool. Great. Okay, so now that we've talked about some factors which don't seem to explain disparity, I wanted to spend a little time talking about factors which might. And so this is, again, not necessarily trivial because we don't have the underlying algorithm that the IRS uses for selection, right? Because they guard their processes very carefully because they don't want anyone to be able to game the system, et cetera. But even beyond that, it's a very complicated set of processes and factors that relate to that result in getting selected for audit. It's not just like one algorithm that we can just write down and look at. So instead, we're going to take a bit of a sort of experimental approach and try and isolate certain factors and see how they might be contributing to disparity. And there's more potential angles that we explore in the paper, but I'm just going to focus on 3 here for the purposes of time. So the first is, back to this question about the underlying distribution of non-compliance. Even though in the plot that I showed you before, it's that the audit rate is higher among each bin of non-compliance, it could still be that because the budget of the IRS to audit is very small, perhaps at the very tail, Black taxpayers could be overrepresented, right? And maybe that's what could be driving things, basically that just the distribution itself could be driving disparity. And so how are we gonna test this possibility? We're gonna look at an Oracle model that basically knows non-compliance perfectly. So it doesn't have to predict, it just knows where non-compliance is. And this is basically showing the sort of revenue and disparity incurred by such an Oracle model, and we're also comparing it to the status quo. So let me just explain this plot in a little bit of detail, since we'll use this kind of plot in the next couple as well. So imagine that the Oracle basically can sort by total non-compliance, and then it can audit up to its audit budget. And we're gonna, vary the audit budget because we don't want to be, our results to be sensitive to this particular choice of budget. So we'll look at a budget between being able to audit 0 to 3% of the population, of the taxpayer population. And we're also restricting ourselves to earned income tax credit claimants because that's, where we see the bulk of the disparity. And so in there, the overall audit rate was about 1.45%. So the blue line and, this path, and along with some error bars, is showing what revenue and disparity the Oracle obtains. And I've called it the total underreporting Oracle because it's looking at just the overall underreported tax liability. It's not concerning itself with differences between where income comes from or where liability comes from or anything like that, just total underreporting. And if you compare it to the status quo at similar budgets, right? So this 1.45% budget, obviously the Oracle gets a lot more revenue, but that's not really a fair comparison because it can see, the future. But the sort of more relevant comparison is that the disparity that it gets is actually negative. It's auditing Black taxpayers less than it's auditing non-Black taxpayers. And that's actually true at any budget. It's basically tracing out a disparity pattern that stays entirely below the 0 line all the way up to this 3% budget. So it doesn't seem like the underlying differences in distribution are, incompatible with non-disparity. But as I said, the Oracle is like a really powerful and maybe unfair thing to compare to. It could be that in reality, because you have to learn and sort of predict what non-compliance might be before you make audit decisions, maybe it's this process of prediction. It actually does become very hard to do this without disparity. And so the way that we're gonna test this idea is basically to say, let's just train our own model. And it's gonna be, a machine learned model, but it's not some, super fancy thing. It's gonna be a random forest that is trying to predict total underreporting. And again, it's using all the features that the IRS has access to. And so this model is the sort of purple one, and it traces a similar shape. It gets a lot less revenue than the Oracle, which makes sense because it can't see the future. But it follows a similar pattern, and in particular, it stays below the zero line for the entirety of the 3% budget. So that doesn't seem like prediction in itself is causing the disparity or is requiring disparity. Now I want to move to a third explanation, and spoiler, this is one that I do think is a lot more compelling about why there might be disparity generated, right? And it's this idea of whether there's a focus on refundable credits to the detriment of other kind of tax liability. So, again, taxpayers can qualify for multiple kinds of credits. Some of them are refundable, some of them are not. And sort of historically, there's been a lot of pressure, political sort of focus on these sort of improper payments for refundable credits. So you could imagine that there might be more of a focus on this. And so the way we test whether this is creating disparity is by, let's just say, okay, if the Oracle only cared about refundable credits, what would it do? And similarly, we can ask, if our model only cared about refundable credits, what would it do? And now you get a very sort of different picture. This sort of blue is the refundable credit Oracle, and this purple is the refundable credit model. And actually, the refundable credit model comes very close in terms of both revenue and disparity to the status quo, which is suggestive that maybe it is capturing something real about what's going on. But the sort of particular point is that in both of them, it's incurring a lot more disparity. It's actually never going below the zero line. So it seems like this sort of refundable credit focus is generating disparity. And then just to show you that I think this really is capturing capturing something real about the audit process, right? We basically took the predictions of the refundable credit model in the solid line and of the total underreporting in the dotted line. And then we sort of binned the prediction percentiles and then just checked what the audit rate was overall. And so you can see that they're both pretty associated with audit rate, right? But the refundable credit is a lot more so, particularly in the tail, and that makes sense, right? Because with these refundable credits that are, EITC, American Child Tax Credit, Additional Child Tax Credit, American Opportunity Tax Credit, there's sort of these maximums that you can get back from them. Whereas, the sort of total underreporting, because it can be from business income and so on, can get sort of arbitrarily high. So those sort of tails is not going to be showing up for the refundable credit, but it might be showing up for the total underreporting. And so that's why, the fact that the refundable credit is so much better of a predictor of the audit rate suggests that better matches what's going on. So I think, of these three explanations, the focus on refundable credit seems to be, clearly more compelling than the other two, and I think overall very compelling to me. And yeah, that's about it for the sort of for what's here. In the paper, we explore other angles as well, but I think that's sort of the summary of the most compelling case for where this disparity is coming from. Just to really briefly wrap up, right? The paper, I think, is useful as a roadmap for how you might do disparity assessment without self-reported race, right? And just to remind you, you get some probabilistic proxy, assess whether these kind of bound conditions hold with some auxiliary data set, and then combine the estimates, to get upper and lower bounds. Further details, standard errors, recalibration in the paper. And then, substantively, the paper shows the presence of significant disparities in audit rates between Black and non-Black taxpayers, shows that they don't seem to be explained by differences in taxpayer characteristics or underlying non-compliance, but rather due to a focus of refundable credits over other types of underreporting. So that's all I have, and happy to take questions. Let's see. Okay, question for the discussion. What is the relevant variable for enforcement? Presumably the IRS auditor has only the same info that's in the algorithm, name and geography. So there's various data that the IRS auditors have access to, right? That they will see the return in particular when they are doing audits. But just to clarify, a lot of audits get a lot of returns get flagged for audit via sort of automatic processes, rules. There are machine learned models of various kinds. So those sort of happen and then get flagged for review. But at least in the initial run, the auditor usually doesn't see the name just to decide whether at least this should go for review. Clarifying question: the EITC is refundable for some and non-refundable for others. Can you, maybe it's worth expanding on by what do you mean refundable for some and non-refundable for others? You just mean
well, for those at much higher earnings levels, effectively it's just reducing their taxes owed as opposed to translating to getting a check in the mail, I guess is what I meant. So it's kind of like the interaction of income and credit application.
Yeah, so we are treating basically credit that is basically for those portions. We're saying forget about whatever is claimed or whatever liability is coming from any other parts of the claims. Just look at the total that like sum up basically over the EITC claims and the AOTC claims and so on. So if a taxpayer would not end up, if it would not be ending up as refundable, we're still counting it as like income that could go to refundable credits, if that makes sense. Cool. Question for discussion: how do you interpret a priority on refundable credits? Is that a political priority, an IRS priority? Could it be driven by perceptions of what groups benefit from these credits, or audits moving away from more powerful groups like wealth and high income? I think that's a super interesting and important question. The impression that I have as a not a public policy trained or person, but coming from the other side, just like looking in from that, is that there does seem to be a lot of political discussion about refundable credits and definitely perceptions about their sort of valence, like the moral valence, which doesn't follow like a legal sense about what liability is. There's no difference in terms of liability legally, whether it comes from one or another, but there does seem to be different ideas about how you should deal with them. I think that's beyond my scope, but I think that's a very interesting and important question. Question for discussion: is there anything about show up rates in audit data? So I've read stories about how lower income filers face administrative burdens and might not make it to show up for the audit. And I've always wondered about how that affects the underreporting system. So actually, this is something that I kind of glossed over, but there's several kinds of audits, right? There are audits where you have to show up, right? Interviews or field audits where people come visit you. But the vast majority of audits for EITC claimants are actually conducted through correspondence. So they mail you something and say, hey, can you provide additional documentation and so on. So it's definitely true that there are differential, or there are studies that suggest that there are differential rates by group of, either not being able to be contacted or basically people not replying to these audits, perhaps because they are not comfortable with the process or are intimidated or something like that, right? And that can kind of differ by groups. I mean, it also could be in those cases that they cannot provide the evidence of eligibility, right? So there's a big there's a couple of papers on this. John Guyton et al. I think it's Guyton et al. But John Guyton has some papers on this which are really interesting. The sort of short answer is I think it's tough to know because by construction it's like people that you've lost contact with. So it's tough to know how they affect the statistics overall. But if somebody basically doesn't respond when you've audited them and it's EITC, generally that's considered a sort of non-dispute. So it eventually gets counted as a non-compliant. Cool. If there are no more questions, I'll turn it over to Danny and Damon for the discussion.